Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, the founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I don't know if what you've done to offend the gods of trading, but obviously something rather terrible, because it has been quite a tough week for you, and actually a tough start to the year for the portfolio.
Yeah, it has been tough. I mean, we've closed 2 trades and we've got 2 out of 2 losers. So, I mean, look, this is real life trading. This happens. 2 out of 2 is not bad. I once had 11 out of 11 in my career. All right, so this is nothing. Yeah, I mean, with the trades we do with what I believe to be high probability trades. We put them on at what I believe to be good levels, and we overlay them with a risk management strategy so that when I'm wrong, the losses are not too significant. And that's the case. I mean, we're sitting now with a loss of 2.8% on our portfolio for the year to date. It's really not the end of the world. We've still got 97% of our money left, and we've got 10 months of the year left as well. Yeah. So, I'm not slitting my wrists about this. This is the real world of trading, and we're not here to put up smoke and mirrors. I'm accountable for what I do, and when I get it wrong, I'll admit it, like I'm about to do.
All right. Well, let's launch into it. African Rainbow Minerals was the trade that you enacted, and unfortunately got stopped out. So tell us what happened.
Yeah, let's have a look. The chart of African Rainbow Minerals is up on the screen now. And regular viewers will know that I'd actually been watching this chart for a number of weeks with the view to putting a trade on, and I'd been very patient and waiting and so on. What I'd seen was that we had this big overhead resistance at 198 Rand, as indicated there, and the stock had broken above that resistance, and it was pulling back and testing the resistance, which then becomes support, and it had done it in a very nice controlled fashion. You can see that the stochastic on the top here had become oversold, or was tending towards oversold territory. We also had an uptrend which came in over there at a similar level to offer a bit more support. So all in all, I felt that there was a good reason to be buying this. I've put up that dotted box over there, which basically is the area that I want to zoom into, just have a look at now, which is there. And there you can see our 198 Rand lateral support level. You can also see the uptrend over there. So I bought for our portfolio at 201 Rand with a stop loss at 194.50 and a target of 220 Rand. Unfortunately, as you can see, it's broken down below that support over the last couple of days. Our stop loss did trigger at 194 Rand 50, and in fact the shares today been trading down underneath 189 Rand. So had we not stopped it out, it would have got even worse. Unfortunately, we did lose money. We lost 4,446 Rand after costs, which works out to be about, I think, 1.7 or 1.8% of our capital. So it's not the end of the world.
Because you actually did risk 1.5% of the capital, which is slightly less than normal, but obviously the trading costs. And can that often happen, and do you need to take that into account? So whereas you might set aside a certain portion of your capital to do a trade, just bear in mind how much it's going to cost you to either, to close it out.
Just bear in mind that you do have transaction costs to go into a trade and to go out of a trade. So, and that's what accounts for the slightly extra or slightly bigger loss than the 1.5% that we had set out what we were comfortable to lose on this trade. But I want to make the point here that everything to me looked good for this trade, and I could show you dozens of similar looking charts where it would have worked. So this is the reality of trading. You do your best work, you identify what you believe to be a high probability trade, and unfortunately there is always an element of not knowing, and that's why we have stop losses and why we have risk management and position sizing methodologies and all those good things. This one didn't work out. It's one of those things. We move on.
And as you say, if you hadn't enacted your stop loss or used your stop loss or stuck to your stop loss, you'd have been far worse off today if it's trading below 100.
Yeah, indeed. And in most of my trading experience through my life, when I've missed stop losses or ignored stop losses, it's got a hell of a lot worse. So it's important to stick to your stop losses.
God, it's interesting though. Obviously, the catalyst for the sell-off that we saw in some of the big resources shares was those Fed minutes that spooked the market in general, but they haven't really recovered, have they?
No, they haven't really recovered, and also commodity prices have been coming off a bit recently. So all in all, it does look as if we've gone into a little bit of a softer patch now for these markets, which is what I'll talk about in the next couple of slides. We've had a very good run, and I know I've been bullish all along. I am still bullish, broadly speaking. I'm still bullish for the year ahead. But I think that possibly things are starting to look as if they could get a little bit choppy now. Volatility levels are ticking up, and we might maybe just be entering into a period of corrective activity on these markets now.
Okay, well, let's have a look at some two charts that would show us a slightly broader picture. And I know you want to start off with the S&P 500.
Yeah, I do. So this is the S&P 500 with looking at it over the last 7 or 8 months. And what I just want to point out is you can see the nice steady uptrend that's in place there, particularly since November up until the recent highs. We've got a nice area of support here at 1475, which joins all those prior tops, what we call pivot points. And that comes in over there at a similar level to where that 50-day moving average is. You can see that orange line is the 50-day moving average. Also, there's an uptrend if you join those recent lows, the November low and the December low, and it comes in at the same sort of area. So you can see that there's quite a strong support area there at around about 1475. So I think first things first, let's watch that support and see how that holds in the days ahead and whether the market respects that and moves up off that level. If it doesn't and we were to then break below that support level, then I think there's a possibility that we'll go lower and test and try and find support at another level lower down.
What would the lower levels be?
Well, that's where I want to bring in this longer term chart of the S&P 500. Now this goes back 4 or 5 years, this chart. And you can see the low of the financial crisis there in March of 2009. Now, if you draw an uptrend from that low and join all the other low points in that rising trend, what you'll see is that we have an area of support which will come in based on that trend line at about 1420. So I think if we were to fail at that 1475 area, then to me there is a chance that we could go back and test this long-term uptrend at some point. I mean, that still is a bullish trend line, there's no question about that. But markets don't go up in a straight line forever. They do correct, and if we're going into a corrective phase and we were to see a sort of a fairly healthy correction, then I think there's a possibility we could go there. That would equate to about a 7% pullback since the recent highs, which is not that much.
And in fact, you have all been calling for a correction. You've been wanting a correction at some stage to get into the market. So, but how does this square with a couple of the charts of the S&P that you pulled up a couple of weeks ago, showing that 1550 resistance and how we're trading on much lower PEs? And would that still be your overarching case that the market is bullish rather than bearish?
Yeah, definitely. I mean, for regular viewers, they'll recall that I did put up a slide a few weeks ago saying that, looking at the fact that that this S&P 500 had bumped up against 1550 many times over the last 12 years. But on this particular occasion, when we got close, the valuation on the PE multiple of this market is much, much cheaper than what it was. And I made the point then that earnings are up over 100% on the S&P 500 from what they were in 2000, yet the market was trading at the same level. So what I was saying is, yes, it's cheap on a long-term basis. And I still maintain that view, and I still do feel that by the end of this year we'll probably be quite a bit higher on the S&P 500. But remember that markets don't go up in a straight line. We have had a very strong run over the last couple of months. So some sort of correction is not, we shouldn't be surprised if it happens. These are the natural ways that markets go. They move up and down and ebb and flow. And they're not going to just go up in a straight line forever.
Okay, so this is the S&P 500. What about the top 40 of the JSE?
Yeah, so here's our top 40 index, and we've looked at this chart many times recently, but we're going to look at it again quickly. What I'd like to just point out here is that this is the trend line going back to July of last year, and you can see that each time the market has pulled back to that trend line, it has found support. Now, we've pulled back again to that area yesterday, and in fact today we are breaking down below that trend line today, which in itself could be a little bit concerning. We need to just see how it responds. Bear in mind, look at that stochastic oscillator on the top there. It's very oversold. So let's monitor it carefully and see. We're at about 35,000 on our top 40 index today. We'd need to regain about 35,400 or thereabouts to get back up above that trend line. So if we don't do that, then I would say that there's a good chance that we've entered into a period of a slightly deeper corrective activity. And that's where I then want to also bring in this longer term chart as well. So here's again the same story as we did for the S&P 500. This is a long term chart looking at the top 40 going back over the last 5 years. And there again you can see the bottom of March 2009, height of the financial market crisis. Now if you draw a trend line in since then and join all the low points, the lows in 2011, again in 2012, you can see, no doubt this is still a bull market, but we have moved up quite a long way up off that trend line. So That trend line comes in at about 33,000 on the top 40. So I think that's an area to definitely keep an eye on in the weeks and months ahead if we were to see a deeper pullback in our market. And that would mean if we were to go there, it would be about 10% down from the recent highs that we've noticed in our market.
Garth, are you quite sanguine about all of this, the trade that you did in Aspen and also African Rainbow Minerals, given that you've got this put spread structure, which is your hedge effectively against a falling market?
Yeah, we have got our put spread structure, which will start to work for us below 34,000 on the top 40 index. And I've got that in as sort of an outside bet against a market correction sometime during the second quarter, which is when it typically would happen on a seasonal factor basis. The thing is, I can then use that in multiple ways. I can either buy against it and utilize it as a hedge, or I can just leave it and let the market fall into the sweet spot of that structure. We'll have to play it as we see it when we get there. But I am quite comforted by the fact that we've got that thing working in the background, and it was relatively cheap to put that protection in place. It is unfortunate that we've lost money on Aspen and on African Rainbow Minerals, but you know, if you don't put your line in the water, you don't catch a fish, and it's the same with trading. If you don't make a trade, you're not going to make any money. So we've got to take the trades when we see them, and obviously stick risk management philosophies in place for when things go wrong.
Before we get to what the portfolio then looks like, your view on the resources index, do you think, because as you said, it's hit a bit of a softer patch, and I think that's where the expectation was that we might see a bit of a recovery, sort of similar picture to last year. Do you think that might still play out, or do you think it's looking increasingly uncertain?
Well, now it's starting to look more uncertain. We've broken a very strong uptrend on that resources index that's been in place over the last couple of months. So I'm now slightly circumspect about that. But again, also remember what I'd said previously on a show previously, that you need to be quite stock specific in the resources sector. You know, there's strong resources stocks and there's weak resources stocks. So I think continue to look to possibly buy the dips in the strong ones, but be wary of the weaker ones. And
just, are there any momentum sectors still, or has it kind of broken down, the momentum that carried through from last year for, say, financial industrial shares?
I still think the financials and industrials generally do have momentum on their upside from a bigger picture perspective. There's no sign to me that those indices have rolled over or are starting to look bearish at all. They still look pretty strong to me. But I think that we could now be going into a period of corrective activity in the market, which is healthy. We need sometimes the market needs to consolidate its gains. And bear in mind, we've gone up on our market, on our top 40 anyway, we've gone up 25% in virtually a straight line without any meaningful correction along the way since July of last year. Now, it's unreasonable to expect that sort of trajectory of gains to continue indefinitely. At some point, the market will consolidate, it'll take a bit of a breather, and I think there's a possibility that we might maybe be starting to see that now.
Yeah. So Garth, what does the portfolio look like then?
All right, it looks like this. So we've got, those are all the trades that we've done for the year to date. You can see Aspen and African Rainbow Minerals are the ones where we've lost money. We do still have a trade open in PPC as well, which is, it's not doing a huge amount, but we are on the right side of that trade. It's been trading up at about 33.50, 33.60 thereabouts today. So we're up a bit there, and we've got our put spread structure where we've paid away a premium of almost 2,000 Rand, and that is working in the background for us. So what it means is that our portfolio is just shy of 243,000 Rand for the year to date. Bear in mind we started with 250,000, so we are down 2.8%. Not ideal, but not the end of the world either. We've still got 97% of our money left.
Exactly.
And we've still got 10 months of the year left, so I'm not worrying about this too much yet.
Look on the bright side.
Always.
All right, Garth, and just to end off with your next courses.
Yeah, so I'm presenting this Saturday on the 2nd of March in Johannesburg, and then the following Saturday, the 9th of March in Cape Town. There are still spaces available on both of those courses, so anybody that wants to come and attend, welcome to email me, garth@traderscorner.co.za, and I'll send you the details.
Okay, Garth, we'll leave it there. Thanks very much, as always, for joining us on the show. That's Garth McKenzie, founder and editor of Traders Corner.